Watch this video till the end, because it will change your view about volume trading. Welcome back to Trading Manifest. In this video, I'm going to talk about volume and volume indicators. I've seen a lot of volume videos on YouTube, but literally none of them talk about the weak points of volume indicators. Yes, they can be powerful, but it's kind of deceitful if we don't warn the beginner traders about the other side of the coin. No waste of time. Let's see what we're going to cover in this video. First, we will state and examine the volume definition in trading. Then we will discuss centralized and decentralized markets and their differences. This one seems irrelevant to the video's topic, but it will all make sense once I get into it. Next, we will introduce the most useful volume indicators and how they measure the volume. In the next section, I will explain how I use volume to boost up my trading results. So let's dive into it. It's common sense to define what we're going to discuss before we actually discuss it, right? So the volume is the total quantity of shares or contracts traded for a specified security. The meaning of the word shares here is quite obvious, but how can we get some insight about the word contracts? How much is one contract worth for a certain security or asset? In the Forex market, one contract of a currency is equal to 100,000 units of that currency. For instance, if you buy one standard contract size or one lot of euro, that means you have 100,000 euros now. For gold, it often means 100 ounces of gold when you trade one standard lot. For stock indices like Nasdaq, one lot means a contract worth of the current price of the index. So we sort of clarified what the volume means for each asset. Now it's time to talk about centralized and decentralized markets. A centralized market is a type of financial market where all trades are executed through a central marketplace or exchange. In a centralized market, buyers and sellers come together to trade various assets, such as stocks, bonds, and commodities, through an intermediary like an exchange or a clearinghouse. In such a place, market data such as bid and ask prices, trade volumes, and transaction history are publicly available. A decentralized market, in contrast, is a type of financial market that operates without a centralized exchange or intermediary. In a decentralized market, trades occur directly between buyers and sellers through various mechanisms such as over-the-counter or OTC trading or through decentralized platforms. In such environment, we may have less publicly available information regarding prices, trade volumes, and other market data, which can make it more challenging for participants to assess market conditions. It seems that we should consider the market type when studying their trading volumes. So first, let's categorize the markets we trade in terms of being centralized or decentralized, starting with Forex. In the Forex market, currencies are traded over the counter through a global networks of banks, financial institutions, hedge funds, and also individual traders. There's no single centralized exchange where all transactions take place. Instead, market participants interact with each other directly or through electronic trading platforms to execute trades. Next is gold. The global gold market is also considered decentralized. Gold is traded across various platforms, exchanges, and in physical markets with no single centralized authority overseeing all transactions. The stock market, unlike the Forex and gold markets, is generally considered centralized. Most stock trading occurs on organized exchanges such as New York Stock Exchange, Nasdaq, or London Stock Exchange, which provide a centralized platform for buying and selling shares of publicly traded companies. Stock exchanges use a centralized order book to match buy and sell orders. ensuring fair and efficient price discovery. So when using volume indicators, we should be very cautious not only about the indicator itself, but about the market we apply the indicator to. Even if we have the best volume indicator in our hands, it might be possible that it gathers less than 1% of total volume for the target market. And when that happens, no matter how good the indicator is, the information it provides has no value to our trading strategy. Now that we know which factors are crucial for picking the right indicator, it's time to review a few volume indicators. Let me ask you a simple question. What's the difference between this volume indicator that appears below each candle and the one that appears on the left or right side of the chart? The first one represents a form of volume that was traded on one candle, whereas the second one indicates a form of volume which was traded at a certain price. This form of volume can be the sum of the buyer's and seller's volume in total, or an average of each one, or any other format of calculating the volume. The second indicator is called volume profile. So which indicator should we pick? Well, I have to say it highly depends on your trading strategy. For example, if your trading plan is solely based on candlestick patterns, you would better want to use volume for each candle. However, for my trading strategy, I prefer to look at volume profiles. Since we discussed centralized and decentralized markets, it's good to say I only use volume profiles for centralized markets, such as stocks and stock indices. To further explain my choice, first I must highlight the volume profile attributes. The first and the most important one is POC, or point of control. This is the price level where the highest trading volume occurred during the analyzed period. The POC can act as a strong support or resistance level, depending on the context. The second one is high volume nodes or low volume nodes. These areas on the volume profile indicate regions of high and low trading activity. High volume nodes can act as a support or resistance level, while the low volume nodes may suggest price levels with less liquidity and less potential for quick price movements. The last one is value area, which represents the range of price levels where approximately 70% of trading activity occurred during the analyzed period. Prices within the value area are considered fair and balanced, while prices outside the value area may indicate overbought or oversold conditions. Now, how do I utilize these attributes in my trades? Well, I only use the first two as an auxiliary tool to help myself find the most reliable support or resistance levels. As you might know, I like to enter trades when a key support or resistance level is broken. If you'd like to get more information on how I use support or resistance levels, you can click the link on the top right to watch my support and resistance levels course. Back to our topic. High volume nodes including the POC can give you excellent confirmations on whether a support or resistance level can be trusted. For instance, if I'm keeping an eye on a specific level, I would measure its reliability by looking at its volume node. If the node is my POC or at least 80% of my POC, this means that my level has a strong confirmation, and if it is not, then I kinda lose my confidence in the level. Let's review what I said with examples. As you can see, this is the highest point on the chart, and it seems like a solid resistance level. But look at the volume at this price range. It certainly is not a high volume node, and thus makes the resistance level less attractive to trade. Now let's imagine the resistance level occurred at this price. Then we could see a high volume node for this price range and we got more confident in trading this level. Another example, this time on the Apple stock. We have a support level at the bottom of the chart, but the relative volume is so low, meaning that there's not much interest or trading activity in this area. On the other hand, if we consider this level as one of our support levels, we have the POC as our trading volume here. I think my approach to volume indicators is straightforward and very easy to understand. Now you can develop your own volume trading strategy based on what I taught you in this video. Would you like me to create more videos about volume trading, like footprints and order flows? Let me know in the comments. Thanks for watching, and I'll see you in the next one.